Good afternoon, everyone. Welcome to NEPC's CIO Conversation Series. This is Tim McCusker, Chief Investment Officer. I hope all of you on the phone are enjoying these as much as I've enjoyed being a part of them. Really excited for today's session. We have Michael Cembalest. Michael is the Chairman of Market and Investment Strategy at JP Morgan. We're going to talk about what's going on in the global economy, and we'll talk an awful lot about some of the specifics of COVID-19 because Michael's done some really great research there. So, Michael, thanks for joining us today. We're thrilled to have you.
You're welcome. Thank you.
So, Michael, let's get right into it. Just as we were talking beforehand, always great. I think one thing that's been really interesting about this whole the lockdown and now the reopening is we are all going through things in the same way. So, tell us just a little bit about how you personally adjusted to working from home. And then how JP Morgan, an enormous organization, made that call to work from home and what that process was like.
Well, it wasn't much of an adjustment for me. I tend to do a lot of my work remotely. I have a small team that I manage remotely, and my wife is much more social than I am, and I'm 58, and so. I may be in the first percentile of people in terms of disruption. So I have adapted remarkably well to quarantining. So I'm not gonna get into it any more than that, except everyone that knows me understands.
That's great. And how about for JP Morgan as an organization? I mean, in total, not just asset management, but in total, 250,000 employees across the world, different stages of coronavirus in different places. How were some of those decisions made?
Yeah, well, those were, I think most management teams in a lot of companies were hoping not to have to go down this road.
Mm-hmm.
And I think JP Morgan is no exception to that. And in late February, the contingency plans that were being made at the time were very selective and surgical in terms of how we were going to respond as a firm to this thing. And then, once we saw what was happening in Italy and that it was on its way to New York, then everything changed. And so, Jamie. I remember when in 2004, 2005, one of the first things that Jamie did was in the old JP Morgan was not very good in terms of technology. And I joined the firm in 87. And at some point in between 1987 and 2000, the firm had outsourced an enormous number of technology and control functions. And Jamie immediately insourced them again and terminated as many contracts as he could, which was a great thing to do because we were much more able to be masters of our own fate here in terms of immediately migrating to work from home because we had control over all the levers of communications and technology and client assets and everything else that you would need. And so I wouldn't say it was seamless, and there was a lot of grumbling about it. But we got there pretty fast, and I think we got to over 90% work from home within a couple of weeks.
Wow, that's amazing at the kind of scale you're talking about. Well, let's turn to the global economy and markets. Your Eye on the Market piece that you publish on a regular basis has had so much great content out there. Maybe you can start by just painting a picture of how you saw this situation evolving. I know you were optimistic a lot earlier than others, and maybe you can talk about maybe first in the U.S. and then the rest of the world, how you're viewing things as the virus trajectory has come down and we're starting to reopen.
Sure. Well, when the last 3 or 4 sell-offs that have taken place over the last 10, 15 years, so much bad news has been kitchen sinks up front that you find, like when you look at 2008 or even at 2001, you find that the markets have a history of bottoming even before the thing they reacted to has started to get better, and while it's still getting worse. right? So in 2008, you saw bank stocks bottom and start rallying even before bank foreclosures and delinquency rates and bank failures had even gotten close to peaking. And we just have seen this over and over and over again where, markets rise, forget about improving employment. Unemployment rates are still skyrocketing in 2008, 2001, and in the mid-90s when the markets bottom. So you have to get ready to add risk even as the variables that you're presumably tracking are getting worse, and even as the PMI indicators are getting worse. And that's, it's been a challenge, but after having lived through a few cycles, we knew that this time the virus indicator was going to be that same variable. So it looks like the market bottom when the U.S. had experienced only 6% of infections, that have occurred to date. And, it's a bizarre world where as an investor, you have to put risk capital to work before 10% of the thing that the market is reacting to has even taken place. But that's what happened. The other thing that I noticed was, and there's a lot of inexactitude to this, but if you started to look at dividend futures and other models that people look at to extrapolate what the markets were pricing in, they were pricing in roughly a 7 or 8 year time period for corporate profits to regain their prior peak. Now, that can happen. During the Depression, it was twice that. But other than the Great Depression, on average, even in nasty recessions, you regain a prior profit peak in 2 or 2.5 or 3 years, maybe 4. So when the markets were pricing in mid-March a 7 or 8 year time frame, I began to look back historically, like when did you find periods when it took 7 to 8 years for GDP and profits to recover? And you started noticing things like the Great Famine in China, the post-World War II rebuilding efforts in Japan and in Germany. And when you looked at the actual fundamentals there, that's when you really saw plague-like destruction of capital stock and employment. So with that backdrop in the middle of March, we just decided that, look, there's enough incentive here to take risks, particularly given the open checkbook that the Fed was up to. Roughly 1/3 of all the facilities that they've launched since March are completely new concepts that weren't even dreamed of in 2008, 2009, which was already the craziest Fed alphabet soup ever. So those are the 2 primary factors that led us to get more optimistic in March.
Okay. And Michael, I don't know if you're able to get a little bit closer to the microphone. It's just coming in a little bit quiet there. But so some really interesting points there. Completely agree on those 2 factors, the virus trajectory and the impact of the Fed and liquidity. One thing that I've heard a lot of folks talk about is increase or trajectory versus levels. I think you've talked about this as well, that the shape of the curve as we reopen, and I think you bring up some great points, that it's before that curve even starts to tilt that the market starts turning, actually. But we're going to reach a point where maybe that trajectory levels off and we're not at prior levels as an economy overall. Maybe some companies in the equity market get there, but many won't. And that path, maybe it's not 7 or 8 years, but it could be long and it could be messy given some of the structural issues that we have in place. How do you think about that? Do you think we're going way higher here with rates as low as they are and all the liquidity that's available, or is there going to be a realization that we're not getting to prior levels for quite some time?
The way that am I coming in a little clearer now?
That's great. Thank you.
Yeah. The way that we've decided to look at this is roughly 2/3 of the market, tech, staples, healthcare, companies that should be able to survive in a pandemic. And then you have the pandemic victims, which is discretionary, ex-Amazon, the financials, industrials, basic materials, and stuff like that. The part that we're comfortable with is that valuations on the first group are more or less flat to where they started the year. And, the valuations are high, but they're not ridiculous.
Uh-huh.
What now seems to be happening is that the markets are now, in contrast to March, pricing in an improved trajectory of economic activity that goes for those victim sectors, that goes a little bit beyond what we think may happen. There's still going to be there's going to be a wave of corporate bankruptcies in the bottom half of the S&P 1500, certainly the bottom half of the S&P 3000, Russell 3000, that has to get sorted through. I don't think the bankruptcy courts are staffed well enough to handle what's coming. And that stuff's going to get messy. But the market cap of a lot of those companies is pretty small. We're starting to put together the infrastructure to provide DIP financing and things like that. But the Fed takes so much juice out of everything. We created a DIP vehicle in November 2008. We thought we were so smart. Mm-hmm. I think we were able to put 10 or 15% of it to work before everything the Fed did just crushed the DIP spreads to the point where it wasn't worth doing anymore. Yeah. And we have this table where we monitor the percentage of the increase in all of the different spread markets that have been retraced. And on average, something like 70 to 90% of all the spread widening that took place earlier this year has been retraced. I mean, why wouldn't it? We're back at zero rates, and we got a whole bunch of endowments, foundations, sovereign wealth funds, and pension plans that are desperate for income. So high yield saw 3 of their biggest inflow weeks ever last month. So, I think at this point, the risk appetite is zooming. I mean, we're seeing a lot of reasonably good indicators. But yeah, at this point, the risk-taking stuff, I think, has taken on a little bit of a life of its own. You're starting to see those. Did you see the story about the company that included a fang-like thing in its name, and the stock zoomed, and the other company that named itself Nikola so that people would give it a Tesla-like valuation? I mean, those are the kind of things that worry you.
It's like a few years ago, if you put blockchain in your name, you're all
exactly.
set. Throwing your money. Yeah, it's crazy. You mentioned indicators. Can you tell us a little bit about using some of the resources from across JP Morgan? You've got some fascinating indicators on real-time spending. Tell us a little bit about that and how you're viewing the reopening playing out through that lens.
Yeah. So this was a first for us, and there were 2 main issues to overcome. One of which is there's a lot of regulatory and legal issues about banks mining consumer data for reasons other than providing credit and debit card services. And so an enormous amount of information had to be scrubbed, and lawyers and everything worked on this for weeks before we got access to it. And, then there were also the issues that not everybody within a large organization wants to share everything. But I am nothing if not persistent. And at the end of the process, as I had predicted up front, I prevailed. And eventually, and you look, Jamie's in complete agreement. Jamie is all about trying to leverage different parts of the firm to work together as much as possible. So we finally got access to this. I've never really needed it before. We've always been fine with BEA and BLS data monthly on a 1-month lag, which is typically what you get. But this time, that was garbage. And so we now have access to real-time debit and credit spending, and we're overlaying it with what we know about reopening policies and virus infection levels. And if you give me a second, the reason this is all important is if someone shows you a national chart, this is what furniture spending is doing, and this is what auto spending is doing. Well, you got a bit of a mixed bag there, because you're comparing places that are reopened, some places that are shut down, some places that have only reopened partially. If the question is, what does spending look like once the virus goes away, you have to have the ability to synthesize your spending data with your low virus infection rate data, because that gives you a clearer picture. And we started noticing that in person, not e-commerce, but in person card present spending at restaurants, amusement parks, hotel, lodging and non-Amazon retail, in-person retail, it was down, I don't know, 60% a couple months ago, and is now down 20%. And it's rates of change that matter. And when we saw that happening, we knew that this was a good signal that a lot of the more catastrophic forecasts of consumer activity were probably not going to happen. And by the way, it didn't take long for us to figure out why wouldn't that happen? 2/3 or 3/4 of all the people out of work are getting, so far, federal and state and local benefits equal to their wages.
Sure.
Right? So if you think about a giant puzzle, the piece that got squished into place was the deficit, right? So you can accomplish all of these things as long as you're willing to sacrifice. We're going to run an Ecuadorian type deficit. I started in emerging markets at JP Morgan. I was the one that worked on the structuring of all the Brady bonds. And in the late 80s and early 90s, we're going to be running deficit levels that I typically associate with small little microstates of Latin America. So, but if you're willing to do that, you can maintain disposable income and you can maintain spending irrespective of a 15 to 20% unemployment rate.
So what does that mean long term for the dollar? On one hand, other developed countries are doing it too, and on the other hand, as you point out, that can't be sustainable.
Yeah, it shouldn't be sustainable. But the difference is that historically, central banks that monetize government debt fall into two buckets. In one bucket, because of the age structure of the economy and capital flows and is it a reserve currency or not, and a whole bunch of other stuff, this behavior becomes inflationary. And then in other countries, it's not. And what I think we've learned over the last couple of decades is in situations where these kind of behaviors are not intrinsically inflationary, central banks can get away with this stuff for a really long time. I mean, for the last decade, the Fed has begun every single year with an upward sloping expectation of the funds rate. And in every single year, it's come in much lower than their forecast. They don't even understand what's happened to the Phillips curve. And every year every year they write stuff. Maybe it was this, maybe it's that, maybe it's industrial robots, maybe it's, changes in the wage structure, maybe, and we were aware of all the theories. Bottom line is the people that are now running the Fed believe that the neutral rate of interest is 50 basis points over inflation instead of the 2% that prevailed over the prior 4 decades. Mm-hmm. So, I don't know how long it lasts. I do know this. At every turn, the ECB and the Bank of Japan do crazier stuff than the Fed, right? In an 18-month period in Europe, the ECB bought more sovereign bonds than were issued by European governments, and they bought more corporate bonds than were issued by European companies.
Wow.
Like that I thought, that's like the craziest thing that I've seen in my career, I think. And then in Japan, you've got the Bank of Japan not just buying sovereign bonds and agencies, but lots of corporate bonds and equities. So as much as the United States seems to be dead set on destroying the fundamentals of a reserve currency, the rest of the developed world isn't necessarily stepping up to the plate and providing a clear alternative. And when you look at the recent pact in Germany and France to provide fiscal stimulus to the weaker states, I'm not sure if that's a good thing or bad thing for European creditworthiness. And so China comes out of this looking pretty good in terms of its debt dynamics and fiscal policy. And, there's no small group of people that believe that when you combine, hundreds of billions of dollars of annual Chinese industrial espionage committed against the West, and a whole bunch of other infractions that they've committed, they haven't really lived up to a single agreement since joining the World Trade Organization in 2001. that they're not necessarily disappointed to see the havoc that this has wreaked on the balance sheets and fundamentals of Western societies. Fortunately for us, there are other problems with the Chinese economy and its capital markets that don't make it necessarily a viable alternative to the dollar right now. Although I know that you had Bob Prince on here. Certainly, if you read the Bridgewater reports, there's no greater fan of the Chinese than Bridgewater.
Right.
All you have to do is read what Ray Dalio writes.
Right. So that's something that we're going to talk more about COVID-19 in a minute, but it's amazing how new topics have emerged throughout this that kind of put COVID-19 on the back burner, between the protests that have come out against racial injustice and what that might mean long term. And then before that, it was U.S.-China relations. Where do you see that going forward, especially given some of the comments you just made?
Yeah. There's no question that globalization has peaked, right? There's several topics that I work on in detail, and there's an energy paper that I write every year, and the energy paper is coming out at the end of June. And one of the topics is, when is peak oil going to occur? Not in terms of supply, but in terms of demand, which has a huge impact on the concept of stranded asset risk. We've reached peak globalization a few years ago. I don't think there's any question about that. What I disagree with is the speed at which it unravels. Trump, by his nature, is a carnival barker. And so there's lots of stuff when you read through the list of all of the things they may do to the Chinese. They may not allow federal retirement plans to run money against benchmarks that have MSCI China, and they may revoke visas for Chinese engineering students trying to get into the United States on false pretenses. By the way, Senator Rob Portman came out with an amazing report last year showing how the Chinese government was funding thousands of Chinese researchers in the United States who were themselves being funded by U.S. taxpayers to steal intellectual property from U.S. research labs and send it back to China, right? So I agree in principle with a lot of what the president is trying to do in terms of stopping intellectual property theft. But a lot of the stuff that's being announced is on the margin. I don't see anything in there really at the core fundamental of capital flows. I mean, there's restrictions for U.S. venture capital funds to employ Chinese nationals. I mean, it's all stuff on the margin. The president still says he will live up to the trade agreement that he made in January if the Chinese follow through and purchase the agricultural goods that they said they were going to purchase. And since China is the most polluted country for its wealth level in the world, not just air pollution, but also soil pollution, water pollution, I have no doubt that the Chinese desperately need access to U.S. agricultural goods. So I expect the Chinese to live up to those purchase commitments and for that deal to be maintained. And at the same time, you're going to have lots of noise about national security, and there's probably going to be less Chinese money going into U.S. real estate. And some of those cross-border FDI flows are going to slow down. But, a lot of the U.S. companies that do business in China are doing business there to meet local demand. They're not producing in China for re-export back to the United States. So changing U.S. tax policy or tariffs isn't necessarily going to change their behavior. And so
what does that do to if you look at that number, what does that do to the trade deficit? If you look at the local sales for companies from the U.S.
Oh, the trade deficit goes away, right? I mean, we had a chart in an Eye on the Market recently showing that you got about $370 billion trade deficit in 2018 before all the tariffs of goods and services trade deficit with China. If you then add back sales of U.S. multinationals in China, it nets to zero. So China sells us stuff, and we sell stuff to China in China. Now, I agree with the president and some of his advisors that does nothing to help U.S. manufacturing workers. Sure. And so that's the reason that they've been trying to do certain things to compel some of those companies to onshore production. It's a very hard thing to do. And so I think there's going to be a lot of noise and saber rattling and things like that. But I don't think that. And then one other thing to keep in mind: there's a perception sometimes that the increase in S&P profit margins over the last 20 years was primarily due to globalization. And there's a bunch of analysis that have come out. Empirical Research Partners has done some good work on this that shows falling interest rates, falling tax rates, increased use of tax havens by U.S. companies, and efficiency gains from plant, property, equipment, and software investment in the United States are 75 to 80% of the reason for expanded margins. And then only around 20% has come from offshoring. So if that's true, a lot of what may come here may not be quite as damaging to margins as people think.
Okay, that's great. So we went quickly around the world there. I'd love to spend some time on the work you've done on COVID-19. So you've been playing the role, you've been leading some of the efforts across all of JP Morgan to research and understand COVID-19. Maybe a little background first. How'd you begin diving into all this? Do you have a background in healthcare where you had some expertise here? How did you go about getting your arms around this issue in the first place?
No, but I have a background over the last couple of decades in being thrown into things that I had no background in. So, I've become like extremely in-depth knowledgeable on the intricacies of global energy markets, wind, solar, nuclear, kite power. And I for the last decade, I've written the deep dive energy paper with Vaclav Smil as our technical advisor. I did the same thing on this question of the unfunded pension and retiree healthcare obligations of U.S. states, cities, and counties, because we manage about $60 billion in munis. And, you don't get the kind of research from Moody's and S&P that you need on municipal issuers that you get from them on corporate issuers. So we had to build some models that would help us understand that risk, because even though there's no explicit cross-default provision between a pension and a bond, every single time pensions or retiree healthcare have been restructured, the bondholders have gotten bigger write-downs. Mm-hmm. So I have some experience being thrown into some of the stuff like this, and knowing that, I immediately put together an advisory group of epidemiologists, mathematical biologists, hospital administrators, and other research professionals, including at the NIH, that would be an informal advisory board for me, so that I could have people each week that I could go to and say, okay, what about this? What about this? I mean, we were the first people that were writing publicly that hydrochloroquine was garbage, because these guys who were working on it were telling me that it was garbage, and they were telling me the personal history of this goofy French doctor who was falsifying data, March getting everybody all excited about it. Wow. So there's really no way to do this kind of thing unless you're willing to invest the time and energy to get people who really know what they're talking about. And, some people don't do that, even within our own firm, right? There are other lines of business that JP Morgan that have published research and to support a certain point that they had, that, lockdowns are stupid, they cited a hyperlink to a research report that said lockdowns are stupid. And when I read it, it was written by an oceanographer at Woods Hole. So there's a lot of sloppy science going on. There's this crazy thesis that countries that use the BCG vaccine somehow are more immune to getting the virus. That makes no sense for a number of reasons. So it's been a lot of detective work, and I'm, most of the time I spend is not projecting what's going to happen, but just trying to evaluate what is happening.
Okay, so less about trying to figure out the trajectory of the case count going forward, just where we are.
Yeah, I mean, the models have been wildly, there's no multi-panel regression where you can say, okay, tell me a place, give me its demographics, tell me how many fat people there are, tell me how many smokers there are, tell me how many intergenerational families living together, what's its latitude, specific humidity. We've done all that, and so it's a very idiosyncratic virus that's behaving very differently in different places. There are some obvious things, like Sweden using a different approach than the entire rest of the Nordic countries and having a much higher fatality and infection rate. Right? There are certain things that are clear, but then there's other things that are less clear. Brazil and other parts of Latin America are having massive outbreaks of infection right now, whereas other countries, that you would think that are similar, whether it's Bangladesh or India or Kenya, aren't. And it's not just quality of data and reporting, because the World Health Organization is basically crawling all over the world and is welcome everywhere except, of course, in China. So, we have pretty good data from a lot of places, and it's a very idiosyncratic disease. The good news is that there are, in the last, I would say, month, there's been a lot of information that's come out about treating sick patients. Do you want me to spend just a couple of minutes on that?
Yeah, absolutely. That's great.
Okay. So up front in March, I thought, okay, we're going to have an antiviral by the summer. That's the good news. The bad news is I think vaccine's 3 to 5 years away. Looking at the history of vaccine development, and then the more I learned about antivirals, there's been thousands of them proposed, and only 90 of them ever were created, and half of them were for HIV. And so antivirals have a very spotty history in terms of being developed. Vaccines have their own challenges, but the vaccine efforts for something like Ebola are obviously very different from the vaccine efforts going on right now. So my opinion has changed since March. I now think that the virus likelihood is higher and sooner, but, the antiviral outcomes don't look good. The remdesivir story is not as bad as the hydrochloroquine. At least there's no deliberate misrepresentation of non-placebo type trials. But, the remdesivir stuff works on mild patients that are hospitalized. So you should stop for a second and say, wait a minute, Mike, how many mild patients end up hospitalized?
Yep.
Not that many. So, because like Tamiflu, remdesivir has to be given early in the treatment, and it has to be given intravenously, right, or subcutaneously. So it's not an outpatient kind of thing. So, and it has reduced time to recovery from some patients from 15 to 11 days. So it's not worthless. It's just not a silver bullet.
Sure.
Where we've seen more progress is how do we prevent sick people from dying? And it turns out that this disease is not just a it's not just a pulmonary disease, it's also a vascular disease. And up front, lots of people were dying from heart attacks, strokes, and things brought on by blood clots. So now patients are getting very basic statins and ACE inhibitors and blood thinners to improve their chances of surviving some of these vascular problems. That's helping a lot. There's another drug that's basically a fancy version of a steroid that also helps block the inflammation that people tend to get when they're on ventilators or getting oxygen supplements. So the doctors and healthcare physicians are learning how to reduce mortality rates for people that are getting sick. And then on the vaccine, this is definitely the biggest global vaccine effort in history. The most important thing to keep in mind is, and on our coronavirus web portal thing, we have this little table. There's 5 kinds of vaccines. There's 5 kinds of vaccine development, or ways of provoking an antibody response. Most of the companies you're reading about, J&J, CanSino, Moderna, Inovio, most of them are pursuing the types that have never been approved before. They're ingenious, they're wonderful, they're very science fiction-y. It reminds me of Fantastic Voyage, that movie I saw in the 1960s when I was a kid. But, most of the companies you're reading about are entering phase 2 trials with a vaccine approach that's never been approved in the developed country. So I just think we have to be mindful of that. And that's because what they're trying to do is get your body to generate the virus proteins itself to provoke the antibody response instead of injecting you with a piece of a live or a dead virus. So that's why, all things being equal, I think the first companies that get there are the ones that are using the techniques that have been done before, but we'll see.
And has there been much progress on those?
It depends. Usually I read the press releases, but then I don't add anything to our web portal until I've had a chance to run the press releases by my advisory group.
Okay.
And, there's been a disappointing amount of Wall Streetification of pharmaceutical company press releases. And in particular, the phase 1 of any drug study is, will it kill you? If you give a healthy person this vaccine, will it kill them? It's all about, is it safe to give it to people? It's not meant at all to measure the effectiveness of the immune response. But you got a lot of companies sneaking language into the phase 1 results saying, oh, we saw this immune response. It was great. But that's not what they're testing for. So we're now just entering the phase 2 trials for a bunch of different drugs, and we'll probably know more in 2 to 3 months.
Okay. You hear stuff from time to time about the virus mutating in some way, and whether it has already or will. What does that mean for the research that's already underway for potential treatments and vaccines, and for how this might spread going forward?
Yeah, the mutations, the mutations that you see in the flu every year are challenging, because you're mutating a certain distance away genetically from where you started from that requires different treatments. The mutational strains seen so far for COVID or for the SARS-CoV-2, virus itself are within the bounds of treatment efficacy for this particular virus. In other words, they haven't jumped into a different lane where the treatments that were developed for the first lane don't work anymore. And so that's another place where I think a lot of the reporting has not been very good. There was also a couple of weeks when the news reports were exploding with people that were reinfected.
Uh-huh.
Do you know how accurate the virus tests are? At their best, 75%. I'm not talking about serology tests for antibodies. I'm talking about the basic swab nose virus test. Peak effectiveness of 80% or so on day 7. And then it's lower before then, and it's lower after then. So all that was happening was you had people that tested positive for the virus. They then tested negative for the virus, and then they tested positive again. And it was all of which was in the band of error. And there's never been a single substantiated case of a person that was definitely shed completely of the virus and got sick again. So both the strain issue, the mutational strain issue, and the reinfection risk issue seem to be de minimis.
Okay. I think tying all this together about the virus, the big question out there on everyone's mind, whether you're thinking about markets, whether thinking about whether your kids go back to school, is the second wave. What are your thoughts on that based on all that you know about this virus?
Right. So we monitor every night. We basically run these models looking for camel humps anywhere in the world. And you can find a few. There's one in Iran. There's one in Israel. So what's a camel hump? You have a rise in infection. It falls substantially, let's say 50, 70, 80% from its peak level. It then gets sustained at some low level where you think you've got it under control, and then it rises meaningfully from that trough. There's as much art as science is there, in designing models that can find those kinds of shapes. We look for them both in U.S. states and different countries around the world, and we have found a few. But given the increase in mobility that's taken place worldwide, it's encouraging that we haven't seen more second waves yet. There's a couple. Arizona looks bad. North Carolina looks bad, right? There's 3 or 4 states that 3 weeks or 4 weeks after the reopening date, they definitely had a spike in both infections and hospitalizations. But then you look at other states like New York and Michigan, and the reopening dates are in the rearview mirror, and the infection rates continue to go down. So it's another one of the mysteries here. So there's no easy linear connection between reopening, mobility, and infection levels. There's theories as to why that may be. It's not herd immunity, that we know, right? Yep. Because in most places around the world, the antibody tests on random populations are showing somewhere between 5 and 15%. So we're near herd immunity. And the most sensible thing I've heard is it's 3 or 4 things at work. Number one, even though there's increased mobility, people aren't doing quite the same things they used to do. in terms of mass gatherings, their hygiene is different. And then sporting events, churches, those are those super spreader type events. And so that behavior is different. Second, a lot of viruses will affect the population and get the people that are most vulnerable to it first. And so it's not about herd immunity. It just means that the next round of people may have a lower degree of susceptibility to the virus. And that's something that people are trying to figure out and look at. And then there's also the weather issue, which is hotly debated, and we certainly look at all the data, but there is some evidence that it's not so much temperature, but humidity, increased humidity dramatically slows down the transmission risk. And one of the more disgusting things that I learned early on is that when people sneeze in cold temperatures, the virions, which are the little virus molecules in your throat, can travel 30 feet, right? 30 to 35 feet. Whereas an infected person in a warm outside human environment, they travel for 1 or 2 feet and then they fall to the ground, and then the ultraviolet rays will kill the virus. So, it fits the pattern of what's happened in other pandemics historically, where you got lower amounts of transmission in the summer, and then you basically have to wait and see what happens in the fall. I'm a little bit less concerned about reimposition of lockdowns, because I just think the bar for so many governors would be so high. You know what I mean? Like, the United States is in Asia, where you have more compliant populations, they've already reimposed lockdowns in certain places. But we have too many gun nuts in this country in order for governors to believe that they could safely reimpose lockdowns in some places. And the other thing too to remember is, when this pandemic hit, we had all these shortages in terms of pharmaceutical supplies. The supplies that it was disgraceful that the United States was so poorly supplied on this stuff, and virus scientists have been warning for years that we were undersupplied. Okay, fine. But on a scale of 1 to 10 in terms of industrial and production complexity, a ventilator is a 2, right? We're not talking about storing spent nuclear rods in a fuel pool. And there was no question that within some period of weeks or months that we would turn that supply deficit into a surplus. And so by the time you get to the fall, in terms of doctors, hospital beds, pharmaceutical supplies, ventilators, oxygen tubes, you're likely to have capacity levels that are high enough to handle what the governors have to deal with without having to reimpose lockdowns. That's what I think happens, and then we'll just have to see.
Yeah. How about testing? Do you see enough tests getting created for?
The testing rates have gone up enormously. Yep. The U.S. has basically closed the gap with the developed world, and is either at the top or near the top of testing rates per population. So per person. So the testing is adequate. It took a long time to get there. But the testing is adequate, albeit with the test inaccuracies that are present in all of those kind of swab type tests compared to actually measuring the viral cultures with a blood test.
Okay. I'll ask you one more question about COVID-19. Then we'll turn to audience questions. And I should have mentioned this at the beginning. This is something, for those of you that have been on a bunch of them, I forget it every time. So sorry about that. On the GoToWebinar box that you have, there's a chat function. Feel free to shoot a question, and we've saved some time for that. My last question on COVID-19, Michael, is about asymptomatic spread. How, in all you've learned about this, it's tough to know other than through testing, and there hasn't been enough of that, how important that's been in the overall spread, what magnitude that is of how many people maybe have it but don't know it. What are your thoughts there?
Up front, there was a lot of fear about that, because SARS-1, the only transmission that was ever recorded, took place from people that were visibly symptomatic. So once you could corral the people that were sick, you could stop the spread of the disease. And that's the reason why the vaccine was never completed. It was, I think, 2/3 done, and then the disease went away, and then companies stopped working on it. It became clear up front that people were contagious with this disease before they were visible with symptoms. But let's stop here, because the WHO confused that crap out of everybody last week for no reason. And let's stop and just put people into two buckets. You could have a person that is contagious and they have no symptoms. But and let's say there's two of them. Or let me phrase it differently. If somebody is contagious and doesn't have symptoms yet, they could be asymptomatic or pre-symptomatic. So it could be a person that's never going to develop symptoms, or it could just be somebody that's about to develop symptoms. And when the WHO came out and said, oh, we don't think asymptomatic transmission is a risk, buried several paragraphs later was their statement, yeah, but we think that 40 to 60% of the transmission of the disease has been from people that were pre-symptomatic, which was an incredibly stupid thing for them to say, because they confused everybody. And in essence, the distinction doesn't matter from a public policy perspective. So suppose I'm running, the office at JP Morgan at 277 Park. If I test somebody coming into the building and they test negative for the virus, and let's assume I'm not worried about it being a garbage test, that doesn't tell me anything, because I can't tell if they're an asymptomatic person or a pre-symptomatic person. So even if it's true that asymptomatic people don't spread disease, it doesn't help you very much in terms of how you're going to manage society and the workplace, because there's no way to distinguish people that are infected and pre-symptomatic from people that are infected and asymptomatic. And so it's a distinction at the end of the day that I don't think matters very much. The bottom line is that people that don't know they're sick can pass along the disease. And the fact that the people that do that only find out later that they're sick, it's too late to help you then.
Right. Okay.
So let's throw it open to the audience in case they have any questions or violent disagreements with anything I've said.
We do have a few questions, and I'm going to save one here as a nice way to end before we go to the lightning round. I'm glad you're getting asked that question, not me. The first one is you mentioned all the stimulation, the Fed thinking that the neutral rate is only 50 basis points instead of 2. Is there any chance that inflation emerges from this, because so much more of the stimulation has been fiscal, whereas last time, 2008, 2009, it was monetary driven?
This is how I would answer that. And I think it's a really good question. But here's the but. From 2010 to 2019, we had the longest period of negative real interest rates in the country's history. The only times that ever rivaled this, the only times you ever had prolonged periods of negative interest rates before this was the Civil War, World War I, World War II, and the time frames were even shorter. So this has been, we just had the longest period of negative real interest rates in history, and for the last 3 years, we've had the largest budget deficits, courtesy of fake fiscal conservative Paul Ryan. We've had the largest budget deficits at a time of full employment in the country's history, and no inflation. So someone would have to explain to me why we would have an inflationary cycle now when we didn't have one during the greatest coordinated monetary and fiscal stimulus period that I can remember. So maybe the extra money printing tips the edge, but I can't put those pieces together so that all of a sudden what's happening now is going to tip the scales when we didn't see it beforehand.
Sure. Okay.
So certainly the pace of money, if you look, we have these charts on M2 plus institutional money market accounts. That number is rising a lot faster than it did in 2008. But what you might get, and what we're seeing right now, is asset price inflation instead of goods price inflation. Yep, that's probably what's going to happen.
Very similar to what we saw last time around. Second question is on the impact of the U.S. presidential election on the markets. What do you see the potential risks there to the market?
Well, yeah, I wrote a piece last September on the on the Sanders and Warren agenda, and it was an agenda that was well outside mainstream Democratic politics for the last 50 years, and on pretty much across the board, sector by sector, whether it was energy, finance, healthcare, pharmaceuticals. There weren't a lot of sectors that weren't up for complete revision, and I think it's less a question about wealth redistribution, right? Because on the margin, if all you do is wealth redistribution, you're taking money from wealthy people to poorer people who have a higher propensity to spend. I don't think the market would care about that. I think the people affected would care about it, but I don't think the markets would care about it. It's the other stuff. It's raising the corporate tax rates would definitely take a chunk out of the market. All of a sudden, you'd start seeing companies doing inversions again, right? No company ever inverted into the United States before a couple of years ago, which was the clearest sign that we had a non-competitive corporate tax code, which even Jack Lew, who was the Obama administration Treasury Secretary, agreed with. So, and so pretty much across the board, there were going to be restrictions on dividends. Companies would either not be able to do stock buybacks unless they met certain tests, and they were going to immediately ban hydraulic fracturing, even though it represents somewhere between 60 to 80% of U.S. natural gas and oil production. Financial transactions taxes. I mean, it was a broad agenda that was fairly radical. I think it's a fair way to describe it, and the way they described it. So then Biden wins the nomination, and particularly with respect to healthcare and energy, had differentiated himself from them by being much more of a centrist. And then the pandemic hit. And so the latest policies that we're seeing from Biden have definitely moved left of where he started. One example is no cap on the payroll tax above $400,000. So, for example, everybody making more than $400,000 would pay an uncapped payroll tax on that amount. For most people to pay capital gains, they'd have to pay a combined unified rate at ordinary income rates. I have a whole table on these things, and so it's I don't know. It's probably halfway between where he started and where the Biden and where the Warren and Sanders campaign would be. Okay. So we'll have to see, right? There are certain things that presidents can do by fiat. Certainly, Trump did a lot of them. Other things have to go through Congress. And so I think the markets will be a little bit more concerned than they would have been a few months ago. And, we'll have to wait and see on whether Republicans hold the Senate, which is probably the single biggest determinant of what happens here. Because Harry Reid, the former Democratic Senate Majority Leader, is encouraging Biden to drop the filibuster, which would effectively give the Democrats a once-in-a-lifetime chance to pass all sorts of legislation if they retake the Senate as well as the House. And, the Democrats historically have valued the filibuster, but are now being pressured by people within their own party that, hey, if we get a chance here, we retake the Senate as well as the House, and we have the presidency, and we only need 3 seats to take the Senate, that they should go for it and effectively do what Obama did with the Affordable Care Act, which is to, get stuff done when they have the margin.
Right.
And so if that filibuster goes, I think that would be an issue.
Quick follow-up to the question of the election that just came in here, but is relevant to that. Do you put much validity in polling numbers today or betting odds that you see, or is it just too early to worry about that?
I think they're interesting to look at, and specifically in the swing states. And in the swing states before the pandemic, most of the polls, and there's 8 or 9 swing states, most of the polls were plus or minus 3%, which is noise. Since then, Biden is now ahead 7 to 8% in most of the swing states. So, yes, I'm definitely paying attention to that. And look, I mean, one of the only things that Trump was really selling in last December was, economic performance and a strong stock market. So it's not surprising that this pandemic, which has dented those things in historically terrible ways, have knocked back his popularity.
Sure.
So, I'm not in the prediction game for presidential elections, but at this point, you have to say it's Biden's election to lose.
Yep, definitely. One last question from the audience, and then we'll go to the lightning round. This is the tough one that I mentioned. What is your year-end 2020 S&P 500 price target, and what kind of probability would you assign to retesting the March lows?
I would put a 10% probability on retesting the March lows.
Okay.
And look, I hate to do this. I'm not really in the S&P forecasting business,
Gotcha.
You can turn on CNBC for that.
Very good. I thought you might not love that one, but thanks for. But
that's
thanks
fine. It's a fair question. I don't think there's a lot of benefit in the answer. Like I'll put it this way: we saw fantastic risk reward opportunities for clients in March.
Yep.
We got less optimistic in the beginning of May, and we're even less optimistic now because of the froth that we're seeing in the market. Could it continue? Absolutely. Where we might have been overweight portfolio risk in March, we're probably now, flat to modestly under risk.
Great.
That's the better way. That's the way an asset manager would answer the question.
There you go. Well, let's wrap up with the lightning round. This has been fun for us throughout the CIO conversation series. Michael, what is the thing you missed most while in lockdown?
I told you up front, I'm struggling with that one.
You're loving it, right?
Can you give me a suggestion?
It sounds like your answer is nothing, so we'll let you have that
nothing.
one.
My answer is nothing.
What's been a pleasant surprise while stuck at home? I'm going to need something more specific than everything on this one.
I never thought that I would have my grown sons back again, which sounds bad, but it turned out to be a lot of fun.
That's great. Awesome. How about a show, movie, or book you've enjoyed the most during the stretch and would recommend to everyone?
Well, my kids have introduced me to Rick and Morty, which I find very interesting and funny and stimulating.
Okay.
And I've also been watching the 3rd season of True Detective.
Nice. Okay, great. The thing that people are not talking or worried about enough is blank.
I think the risk of no vaccine.
Okay.
That the phase 2 and phase 3 trials fail, and that you get, and that in perpetuity that you get a shift to e-commerce that creates massive haves and have-nots in real estate, logistics, and all sorts of other sectors that are very disruptive, particularly for U.S. corporate sector that's over-leveraged.
Right. We could probably spend a whole hour just on that. Last one, do you have a prediction on a way our world will be permanently changed?
Yeah, if you want to recommend somebody read something that people wrote in the past. I wrote this eye on the market called John Stuart Mill, because he's the guy that always used to talk about how he would visit places 5-7 years after a war and how remarkably similar the place was to before the war. And that's the piece I wrote in March when I said, I think we're going to be 70 to 80% back to normal next year. I know nobody wants to hear that right now, but that's what I think is going to happen. I'm not a futurist because everything I've learned over, like, you know, in my investment career is how much things stay the same rather than change. Everyone's expecting, you know, radical changes in electrification of cars and carbon issues, and everybody expects radical changes in work from home and online education and radical changes in the U.S.-China relationship. And a lot of things just don't change. Big, complicated things just don't tend to change that quickly. So, but of all of the, I think CBD real estate is making me real nervous right now.
Okay.
I mean, that, you know, Barry Sternlicht gave a talk a couple months ago where he talked about the fact that he was bullish on commercial real estate because of the virus. Companies would have to spread their employees out in larger spaces between them, which was going to increase demand for commercial real estate. And I thought it was one of the most ingeniously clever book talking experiments that was ever conducted. But I, for the life of me, like, cannot bring myself to that conclusion. And so if there's one thing that you really could see a material change, it's and I don't think it's because of people fleeing urban centers, right? Most of the migration that's taking place in the United States is taking place for tax reasons, right? When we look at the IRS data, we see the people going from Cook County in Chicago, Illinois, which is now irrevocably insolvent, moving to the west coast of Florida, people from the Northeast moving to the east coast of Florida. Most of the people are not moving because they're scared of pandemics and living in an urban environment. They're moving because of tax issues. And so you get that, plus you get a combination of people just much more comfortable from working from home.
Right.
And that changes things. I frankly don't know. I'm 58. I'm not sure I'll ever see my office again.
Wow. Wow. That is a heck of a note to end on. Michael, this has been awesome. We've done a bunch of these. This one was especially interesting. I know I learned a lot about COVID-19 from chatting with you today. I hope everyone can join us next week. We're going to close down this series and give ourselves a summer break. We'll have Cliff Asness join us, and we're going to do a deep dive on value. But Michael, thank you again. Thank you for all the great research you've been producing in your Eye on the Market series. And thank you for your time today, for sharing your insights with our clients. We really appreciate it.
You're welcome. Thank you very much.
Take care.
Okay, bye.